Hi, and welcome back again to Tim Bigham's Big Time Options. We'll be taking a look today at another volume and volatility opportunity, or should I say opportunities, as 4 ways to play unusual option activity, UOA, in quantum computing. So let's jump in and take a look, shall we? First of all, here is the scanner that I built on the Thinkorswim platform, one of the ones I use, showing Friday's unusual option activity where we have a pop in implied volatility. So again, looking for the inputs, kind of screening out for unusual option activity, and then adding that important has to increase implied volatility. So top of the list, actually, quantum computing, QUBT, the July 15 calls with over 28,000 trading, so certainly big option volume. Also showed up on another scanner I take a look at. You can see here the same option, quantum computing, July 15 calls, a little over 28,000 versus less than 3,000 open interest. This is the hallmark of unusual option activity. Big option volume that greatly exceeds the open interest. You know, it's new, fresh buying when it jumps the implied volatility as well, and you can see certainly some big volume there. So taking a look at those July 15 calls, here is from Thursday, the day before that big unusual option activity. You can see implied volatility on the options just about 123 or so. So certainly high implied volatility, quantum computing stocks in general. This one happens to be called quantum computing as far as the stock name, but certainly carry some high levels of implied volatility. You can also see that the delta on this option is well out of the money. The stock closed at just under $8 on Thursday with about a 22 delta. Fast forward to Friday, the day we saw that big volume coming in. Here's that 28,000 contracts, as you can see again, versus less than 3,000 open interest. More importantly, we're seeing implied volatility now over 140, so a huge jump in implied volatility. Stock moved from just under 8 to just under 8.5 to 845. Notice too, the delta on the option moved from 22 to 32. That's the nature of when you get an increase in implied volatility. It moves the option deltas towards 50, both from the downside and upside. So to take a look at it combined, you can see the stock over the course of Thursday to Friday gained 51 cents. That July 15 call, right, which the prior day closed basically at 50 cents, 45-cent bid, offered at 50 cents, right, jumped to just under $1. So the July 15 call gained almost as much as the stock. We noticed that delta, right, went from 22 the day before, right, to 32, more a function of the jump in implied volatility. The implied delta, this is kind of what I look at, right, which is how much did the option price move in relation to the stock price. That is basically, what you would expect on the option, right? We're looking at the implied delta on the option. You expect, probably given a 50-cent move or so on the stock, and let's call it a 30 delta on the option moved 15 cents, but it actually moved almost 50 cents. That implied, right, delta now on that option, if you take a look at it, simply take the move on the option divided by the move on the stock, right, kind of that sort of thing gives you a 93 implied delta. That's what you would be, everything else being equal, right, implied volatility remaining constant. That's how much you'd expect a 93 delta option to move, right? Not a 30-ish delta option. So that huge jump in implied volatility of 19 points certainly put things in perspective here. You can take a look too from IV. Here it is. Here's that 120-day IV, which is roughly those July options, right? You can see that huge jump up here. You can also see it on a Thursday to Friday basis here, went out towards the long and 120-day, which July's are about a 110-day, but certainly the curve shows it all basically moving from about 120 before the big call buying to well over 130 after that big call buying. You can see July with the biggest percentage move because that's where the call buying was centered in, with over 34,000 contracts overall trading in July. The big chunk of that, those 28,000 or so July 15 calls. So what sort of trades does that set up? We can do a couple scenarios here, either lean with that big call buyer, right, lean bullishly, or do a straight vol capture trade, take advantage of that huge jump in implied volatility, right, look for it to revert back towards where it was before. So simplest trade and the easiest one to execute too. Everyone can do a covered call trade, buying the stock and selling the call. Certainly makes a lot of sense here. So pulled off. Here's the day before that big call buying out there, right? Stock closed at 794, and I went to a more closer to the money July 10 call. Implied volatility lifted everywhere, right, across the entire vol surface. You know, as we can see here, basically for the most part it lifted across every expiration. But doing a slightly less out of the money covered call, right, gives you bigger downside protection and still allows plenty of upside, as we'll see in a second. So here's the day before that big call buying. Stock, as we said, closed at 794. That July 10 call slightly out of the money, right, of the stock at 794, about 2 points out of the money. Closed basically at $1.07, $1.08 here. One bid offered at 115. So the covered call trade, the buy the stock, sell the call, or the buy right, would have cost about $6.86, simply buying the stock at 794, selling that call somewhere around that $1.07, $1.08 level. IV at the time on this option, about 116. Net delta, you'd be 59 deltas net long. Stock is 100 deltas, then selling this call with a 41 delta would reduce your bullish exposure, but still be bullish, so you still could lean certainly with that big call buyer out there, right, and look to capture, the fact that the stock hopefully going up. So you had upside until you got to $10, right, of about 40%, 39.48% as far as your upside gain until you're capped off at that $10 strike price. The downside protection, right, what you pay for the stock versus, where the covered call was trading at, right? So you had about a $1.07.5, which is the price of the call, downside protection on the trade, or that call protected you for about a 13.5% drop in the stock, allowed you to potentially make almost 40% if quantum computing closes above $10 in July. Fast forward to the Friday with that big call buying again, that 28,000 lifted IV everywhere, right? We can see the IV on these July 10 calls went to 132, so a nice 16-point pop in the July 10s as well. July, obviously, IV exploded everywhere. So the stock closed at 845. That was up 51 cents from the prior day, right? That July 10 call, though, actually went up more than the stock. Why? Because we saw this huge jump in implied volatility. So the July 10 call, which is still out of the money, rose 60 cents, with the stock only going up about 50 cents. So that covered call trade, buying the stock, selling the call, actually decreased in value by almost a dime, even with the stock going up over 50 cents, or a very nice percentage, certainly for a stock trading around $8. So the IV, the responsibility for that all, 16-point jump in IV. The net delta now, by buying the stock, selling this still out of the money July 10 call, would lower the net delta to 50. Why? Deltas increase towards the absolute value of 50 as implied volatility increases. So your upside on the trade, if quantum computing in July closes above that $10 level and you get assigned, right, you can make about 47%, or about 8% more than before the big call buyer jumped the price of that option, right? The fact you're able to buy the stock and sell the call for a greater price than what the stock rose increases this percentage return. It also increases your downside cushion, right, to that $1.6750 or whatever you sold the call for. So you have almost 20% cushion on the trade to the downside. So you have a bigger margin of safety, much bigger percentage return, all because that big call buyer on these July 15th lifted the price of the options. We can also look at a straight kind of vol capture trade for those who don't want to necessarily lean with that call buyer out there, but just want to capture implied volatility on both sides of the market. Calls rose, certainly puts rose as well because of put call parity. So simply went out and looked at the July 5 put, July 15 call, sell strangle, right? Selling the 5 put, selling the 15 call. You can see the day before the big call buyer on Friday, that sell strangle trading just under $1.40 at $1.3750. The IV on the trade generalized about 135 here, about 122 here. So roughly about 130 IV. By selling that out of the money call and out of the money put, you would have been slightly short the market, about 5 deltas net short. Notice that the put is only 294 out of the money, right? The call is 706 out of the money. So even though the call is much further out of the money, right, than the put that we're selling, because of the drift in stock and because of the high implied volatility, even before the call buyer stepped in and raised it even more, makes this upward drift more. So you do have out of the money call deltas somewhat exceeding what they normally would in a lower implied volatility stock, but basically a neutral trade. Then fast forward to Friday, the day after that big call buyer stepped in. You can see that $5 puts, $15 call sell strangle now jumped to $1.8750. Previous day, as we said, that exact same sort of sell strangle was only trading at $1.3750. So you'll see that sell strangle jump 50 cents. Why? Because IV exploded to 147, right? It closed at 147 when you take kind of the average of the do here. The day before, that IV was just under 130, so about a 17.5 point jump in IV means that sell strangle jumped 50 cents, right? And this is a still well out of the money sell strangle on both sides here. You're now 345 out of the money on the puts, right? And you're looking at, somewhere around 6.5 points out of the money on the call side here. So still well within the range on either side. And again, the implied volatility made that price of the sell strangle jump pretty much an incredibly 50-cent move here. So your break even on that obviously exploded to the downside, basically just somewhere right around the $3 range. To the upside now, just under 17, as before you were looking at somewhere around 350 and 16.5. So that shows you the big edge you get with that kind of jump in implied volatility, as both puts and calls jumped dramatically. You can see the puts were 85 to 90 right before the big call buyer. After the big call buyer, they actually went up a little bit. They were 85 to 95, even with the stock up 50 cents. The calls basically, or the puts I should say, stayed pretty much unchanged, crept up a little. More importantly, those calls, right, closed at 97 cents after the big call buyer, before they were 50. So that sell strangle, that's where the explosion really came from. The upward move gave you a bigger cushion now. The spread is basically more in the middle. 10 is the midpoint, ideally, price-wise, where you'd want this trade to be. It moved towards 10, not even above 10, right, or threatening on the call side, just crept up. Yet because of that big call buyer exploding IV everywhere, that sell strangle jumped in price. And for those who want to do more of a defined risk trade, same sort of thing on the Iron Condor. Moved it down one strike from the 510 sell strangle to the 6.4, 14.16 Iron Condor. So selling the $6 put, $4 buying that put on the one side of the Iron Condor and selling the 14.16 call spread on the other. You can see the day before the big call buyer, that Iron Condor, 95-cent net credit, IV on the trade, roughly about 125. The put side of it, just under $2 out of the money. The call side of it, just about 6 points out of the money. Your risk on this, you have a 2-point wide spread. Only one side can get hit, right? So you're risking $1.05. Potential return 95, right? So your potential return on risk, a very nice 90% or so. Fast forward again to Friday, you can see what happened here. That Iron Condor jumped to $1.10 net credit, right? Which means your risk is lowered now from $1.05 to 90 cents. So from over $1 to under $1, return of $1.10. Your return on risk now well over 100%, and you're still have a very nice cushion on both sides, right? The call, even though it's a little bit less out of the money, still over 5 points out of the money. The put, or even more out of the money. And in a second, we'll see what happened to the put spread side of that. So this is certainly a way to take advantage of a jump in implied volatility. Similar fashion, but defined risk for those who don't like to be naked options. Also lowers the margin requirement on the trade, but you can see that that Iron Condor increased 15 cents, which for a trade that was under $1 is a big percentage gain, right? You're looking about an 18% gain on the price of the trade. Why? Because you had IV jump 18 points. And then for those who want to, again, lean bullishly with that call buyer out there, doing it a little bit different way, right? A little bit lower cost, right? Simply selling a put spread here. So selling that July 6-4 put spread. So the day before that big call buyer stock at $7.94. That put spread trading about 77.5 cents, right? It was out of the money by about 24.5%, right? So your risk, $1.2250 if you sold it at 77.5 cents. Your return on risk, 63% or so. So a very nice return on risk with a decent cushion of 24%. Your IV on the trade, somewhere again around that 130 level. Then following that big call buyer, it jumped the IV almost to 150, right, on the put spread side because of put call parity. If IV rises on the call side, put spread has to rise as well. Stock closed at $8.45, so you saw that 50-cent gain basically in the stock price. The put spread actually went up in price, right, by about 7 cents or so. So with the stock going higher, the put credit spread actually went higher too. Why? Because you saw that huge jump in implied volatility, right, all the way up to that almost 150 level. So you got a bigger cushion. That spread is now out of the money by almost 29%. Almost 2.5 points out of the money. The day before it was less than 2 points out of the money, right? Or less than 25% out of the money there. So you got a bigger cushion, but you got the bigger credit on the trade. You got 85 cents. The day before you got under 80 cents on the trade. So bigger cushion, bigger credit. That adds up to a bigger return on risk. So your risk now has dropped to $1.15. Your return on risk, you can make 85 cents for risking $1.15, now over 10%. The day before the trade, you can see it was a much lower number here. So your return on risk, I should say, 73%, almost 74%. The day before it was about 64%. So a over 10% increase in return on risk with a bigger cushion, right? All due to the fact that that big call buyer drove up implied volatility. So hopefully provide some insight and several trade ideas depending how you want to play it, right? Do you want to lean with that big call buyer out there, do a covered call trade, basic buy the stock, sell the July 10 call a little closer to the money call than where that big volume was, right? Do you want to do a vol capture trade? Do that sell strangle that exploded from basically $1.40 to almost $1.90, all because of that big call buyer jump in IV. Do a similar kind of trade, but do it with more defined risk, right? With an Iron Condor, where you can have that spread go up almost 20%, all because that big call buyer drove up IV, or lean bullishly, similar in nature to a covered call trade, but doing a put spread trade out of the money where you have a bigger cushion to the downside and a bigger return both, all because that big call buying drove up IV. So you can have the trade go against you a little bit more and get a bigger return, right? All because the big call buyer drove up the price of options. So hopefully provide some insight into how we go about identifying different trade opportunities here using volume and volatility at big time options. So until next time, as always, here's the good trading. Take care.